Your house is not the problem. The mortgage is not the problem either. The problem is something that happened after you signed, something nobody warned you about, and it has been quietly running ever since. Most people who feel house poor assume the solution is to earn more. It isn't. And chasing more income while this mechanism is still running is like bailing water from a boat with the plug still out. Here is the counterintuitive part. The house did not make you poor. The house revealed that your financial structure was already fragile and then locked you into it. Before the mortgage, the fragility was invisible. Rent was high but flexible. You could move. You could adjust. The moment you signed, the fragility became fixed, and fixed fragility has a different name. It is called being house poor. I want to show you what house poor actually looks like in the numbers. On a $55,000 salary, take-home runs approximately $3,600 a month. The average first-time buyer at this income level carries a mortgage payment of $1,400 to $1,700. That is 39 to 47% of take-home, gone before a single other bill. Add utilities, insurance, maintenance, council tax, or HOA fees. The true cost of home ownership typically runs 1 to 2% of the home's value annually in maintenance alone. On a $280,000 home, that is $2,800 to $5,600 a year. $233 to $467 every month that most buyers never budgeted for. That maintenance number is the one that locks people in. I call this the hidden ownership cost. It is not dramatic. It does not arrive in one painful moment. It arrives as the boiler that needs servicing, the roof that needs a section replaced, the appliance that fails 3 months after the warranty expires. Each one individually manageable. Collectively, they consume exactly what was supposed to become financial breathing room. The exit is not selling. The exit is restructuring what the house costs you without touching the mortgage. 4 steps. This order, starting this month. Step 1. Calculate your true monthly ownership cost. Mortgage plus utilities plus insurance plus 1% of home value divided by 12. Write the exact number. Most house-poor homeowners have never calculated this. Approximately is the enemy of a 12-month exit plan. Step 2. Build a dedicated maintenance reserve, separate account, separate bank, funded at $200 to $300 per month automatically. This single change stops the emergency spend cycle that drains every buffer you build. The boiler stops being a crisis when the money for it already exists. Step 3. Audit every subscription and recurring charge attached to the property. Streaming, security monitoring, lawn services, storage units rented after the move. The average homeowner carries $120 to $180 in property-adjacent recurring costs they no longer actively chose. Cancel what you did not consciously renew this month. Step 4. Redirect every recovered dollar to one target only, a 3-month ownership reserve, not investments, not extra mortgage payments. 3 months of true ownership cost sitting in a separate account. That reserve is what converts house poor into house stable. Here's the honest part. This is not comfortable. Funding a maintenance reserve while already feeling stretched feels like adding pressure to a system that is already close to its limit. It was not comfortable for me either. But uncomfortable for 3 months, building the reserve is better than the alternative, which is comfortable and house poor for the next 30 years. The house was never the mistake. The structure around the house, that is what needs 12 months of attention. Start the true cost calculation today. That number, whatever it is the beginning of the exit.